Welcome back to Yahoo Finance. I'm Brian Sozzi, still in Tampa at DoubleLine's Key Investor Day. And joining me now is Luz Padilla, DoubleLine International Fixed Income Director. Luz, good to see you here this morning. Thanks for joining us. The thread that is tying all of our interviews together today with the DoubleLine team is interest rate risk, lots of fear and concern about what the Fed may or may not do on rates. From an emerging market perspective, how do higher rates impact what you're doing?
Well, they obviously increase the cost of funding for our countries and our companies. But it's been interesting to see the rise, especially these last couple years, I would say. And now we're at a point where all-in yields for emerging market debt are around 8.5%. I think 9% is an interesting level if people are thinking of getting into an asset class that I think is an improving credit story. So to me, when you look at all these countries, all their potential with their natural resources, their population, they have a lot to work with, and they've done a good job. As I was telling you earlier, this asset class came from basically almost being unrated to now 50% of our countries are investment grade rated. I think we can, do better, and in fact, we have done better. So I think that will continue, mostly because people want a better life, whether they're in the U.S. or they're in Brazil, and I think they'll demand that from their policymakers.
If rates in the U.S. do touch close to 6%, if the Fed pushes that far to fight inflation, what type of ripple effects will happen in emerging markets?
Well, I think certainly that could happen, and it's something that everybody's sort of concerned about. It'll depend on what happens with growth. I think right now, people are talking about a no landing scenario, which means no recession, and so I think that could be an interesting situation for emerging markets, because emerging markets have been growing at almost multiples of what developed market rates are doing. And so if we don't see a recession, that means that all these countries, all these companies can continue to do well. And so I think that could offset, that increase in yield, because we may see spread tightening on the other end.
What's the best position emerging market from your vantage point?
Well, this could be, again, a bias. I like Mexico. Mexico, seems to be ready to be able to take advantage of, the what they call now nearshoring of your products. And so instead of going to China, you may see more people open up more factories in Mexico. I think they also have natural resources. They have a good population, and so I expect that they will continue to migrate up, their credit curve.
Are you putting a lot of money to work in China on the view that the economy will rapidly improve as it continues to reopen later this year?
We actually did the opposite, and the reason for that is mostly to do with Russia, and the after effects of the Russian invasion on Ukraine in our markets were, even for me, I think, having been in this particular asset class since '94, were shocking. Basically, Russia was almost immediately taken out of our index. They went from an investment grade story to a non-rated credit. Then people couldn't even invest in Russian credits. And so, they went from trading 200 over to 1,000 plus in almost the blink of an eye. And, had nothing to do with their fundamentals and everything to do with their, maybe nation building, if you want to call it that. And not that we would expect the same the same treatment for China, but, the Chinese credits that we look at are investment grade rated. They're not yielding a lot. And so for me to have that one thing out there, that could basically blow up your whole investment case, that may or may not come true, but where you're not really getting paid all that much. And how do you even price that? If China invades Taiwan, then what happens to the Chinese credits? So to me, I'd rather not participate at this point.
So you're not positioned as if there is an invasion. You're
not
there yet.
I'm not there. I don't think. I hope, like everybody else does, that it doesn't happen. I think, but when, or maybe not the Chinese, maybe they do want, but most everybody in the world. But I I do think that there is a low-level risk that could increase, the spreads of those credits. And so, again, at this point, there are much more interesting opportunities elsewhere without that particular risk.
We're 1 year. We're coming up on the 1 year mark of the Russia-Ukraine war. Why, from a stock standpoint, why is that event fallen in the background, in the minds of investors? And then what does it mean to emerging market debt? Because clearly this war is continuing.
It is, yeah. Investors have short memories. It's sad to say, and unless it's ever present and you're getting beat over the head, people can just let that go. I think for us, we have to care because it will impact, let's say, the region. And so for me, I look at that whole region, and again, it's difficult to put money to work there. In terms of like the equity markets, you have your own issues. So for me, I look at, U.S. companies and maybe European is more closely attached, but Asian companies, and they're like, okay, we've got our own stuff to deal with. Whatever's happening there, it seems to be muddling along. And as long as that continues, we're okay. As long as there's no increased escalation. It could happen.
And when you model out different scenarios, when you're putting money to work, is the Russia-Ukraine war still a key risk you think about, and how high up the pole is it?
It is still a risk because an escalation could occur, and then we're talking about a sort of more global problem. I think right now, let's say the base case is that the U.S., Europeans continue to support Ukraine. This thing will kind of continue to muddle along until both leaders decide, okay, where is the off ramp? Is it new leadership in Russia? Maybe, but it's really hard to see that right now.
You also have an interesting snapshot into India, looking through the prism of Adani and just the ripple effects, that situation, of course, that short seller report against Adani. What has been the appetite for India's debt given that situation?
Well, certainly for the Adani debt, it's been sort of, almost a tale of two types of investors. Distressed investors have come in and snapped up some of those bonds. And then what we call real money investors, or maybe crossover investors, i.e. investors that invest in investment grade credits that will go into, EM companies. They couldn't find the doors fast enough. And so you've seen, the moves in prices. For us, as I was telling you, it's time to retest our assumptions, relook at what we thought we knew. Is it still true? Adani has always had, let's say, a checkered past. So that's something that if you didn't know that going in, you probably hadn't done a lot of research on it. And it's interesting because we've been talking to some local analysts, and that's basically some of the same commentary that yes, there always has been, let's say, some concern regarding the transparency of that company. But when you look at the hard assets that they have, the products and services that they generate, they seem to provide a real value proposition.
Super helpful insight. Luz Padilla, DoubleLine International Fixed Income Director. Good to finally speak with you. We appreciate it.
Thank you so much.